Okay, there is this organization called NGFS, which is the Network for Greening the Financial System. It's a consortium of many central banks and advisors, supervisors. So it's come together to worry about the future of how to keep the system green as we want to head towards decarbonization, net zero, and so on. Just to read off the general provisions of the NGFS, Article 1, objectives of the central banks and supervisors Network for Greening the Financial System. The Central Banks and Supervisors Network for Greening the Financial System, NGFS, is a group of central banks and prudential supervisory authorities willing on a voluntary basis to exchange experiences, share best practices, contribute to the development of environment and climate risk management in the financial sector, and to mobilize mainstream finance to support the transition toward a sustainable economy. Its purpose is to define, promote, and contribute to the development of best practices to be implemented within and outside of the membership of NGFS, and to conduct or commission analytical work on green finance. So essentially they realized recently that they want to track the climate risks into the financial systems so that the banks are quantifying the risks of their loans and investments and whatever else, and estimate default rates, etc., at various granularities. So NGFS does it at a global scale, and then some country scale information is looked at arising out of the so-called integrated assessment models, which ingest the climate risk narratives from the IPCC reports and then translate it into various sectoral or financial system scenarios going into the future. So the key messages here, scenarios of the NGFS, this is the second phase. They had a first phase, and this is the updated version of their scenario storylines. Scenarios differ markedly in their physical and transition impacts, with significant uncertainty in the size of the estimates and variation across regions. Okay, so I won't read all these details here, but essentially, the NGFS scenarios have been developed to provide a common starting point for analyzing climate risks to the economy and financial system. NGFS scenarios are not forecasts. Instead, they aim at exploring the bookends of plausible futures. So it's storylines for the future, possibilities, what if scenarios, and so on, just as they are for the climate projections as well. And as I have repeated many times, if you look at climate projections from various models out to 2100, the first couple of decades are dominated by model uncertainties, or what lack of fidelity to the real world exists in models, and how that affects the evolution in the next 2 decades. Beyond that, the uncertainties in the projections are completely dominated by the scenarios, which we will look at a little bit here, and also in the next podcast focused on the US. So the same climate scenario analysis for the financial system over the US. Okay, to reflect the uncertainty inherent to modeling climate-related macroeconomic and financial risks, the NGFS scenarios use different models and explore a wide range of scenarios across regions and sectors. Different models produce different results. Consensus doesn't mean it's the right answer, and differences generally just provide you a range of possibilities rather than saying the uncertainty is unmanageable, or and so on. Okay, in this third iteration, sorry, this is the third iteration, not the second, the NGFS scenarios have been brought up to date, including by incorporating countries' commitments to reach net zero emissions, and have been enriched with more sectoral granularity and a finer representation of physical risk, including acute risks. So we'll look at chronic risks, acute risks, and transition risks in the next podcast as well, but that one will be focused on the US. Reaching global net zero emissions by 2050 will require an ambitious transition across all sectors of the economy: steel, transportation, cement, and so on. The NGFS scenario scenarios show that immediate coordinated transition will nevertheless be less costly than inaction or disorderly transition in the long run. More precisely, physical risks in a hothouse world scenario, we'll see what this means. Current policies or nationally determined contributions scenarios, in other words, the current promises made by the countries under the Paris Agreement are not commensurate with the 1.5 degrees C or 2 degrees C warming targets by 2100 with 67% probability. So we are going to exceed the targets and end up in the so-called hot house world scenarios. These will lead to the strongest negative impacts on GDP, with economic costs diverging significantly after 2040. So we'll see. So the scenarios from the NGFS provide certain guidelines, certain inputs, and then the integrated assessment models take all those and then produce future evolution of financial risks and so on. So objectives and framework: the NGFS scenarios explore the impacts of climate change and climate policy with the aim of providing a common reference framework. There are 6 scenarios arranged with orderly scenarios, disorderly scenarios, and hothouse world. Orderly scenarios assume climate policies are introduced early and become gradually more stringent. Both physical and transition risks are relatively subdued in this collective action, whereas the disorderly scenarios explore higher transition risks due to policies being delayed or divergent across countries and sectors, so overall coordination is less. For example, carbon prices are typically higher for a given temperature outcome. The hothouse world, as we just said, assume that some climate policies are implemented in some jurisdiction, but globally efforts are insufficient to halt significant global warming. The scenarios result in severe physical risk, including irreversible impacts like sea level rise from the loss of glaciers, for example, and heating and steric expansion of the water column over the oceans. The NGFS scenario framework then considers the transition risks going from low to high on this axis and the physical risks going from low to high here. So if you keep the transition risks and the physical risks at the lower end, you have orderly transition with possibilities of net zero 2050, reaching 1.5 degrees C global warming by 2100, and here, as we increase the physical risk and the transition risk, we end up with below 2 degrees C, which is worse than 1.5 degrees C, even though, as I've discussed elsewhere, these are not purely scientifically derived targets. They came, in fact, out of assumptions made by Bill Nordhaus in the 70s for what is a safe warming target for economies, for example. If you go to this end with the hothouse world, you have the nationally determined contributions that countries have submitted and updated under the Paris Agreement, and the current policies which are not stringent enough. If you go towards higher transition risks with lower physical risks still, you have divergent net zero but still aiming for 1.5 degrees C and delayed in terms of 2 degrees C. This is the disorderly transition. Too little, too late. Basically, you have no chance of meeting these targets. You will cross 2 degrees C and so on, and net zero, of course, as well. So scenarios at a glance, again, not going too much into details. Orderly, disorderly, hothouse world scenarios within them. How to reach net zero 2050 or stay below 2 degrees C, or divergent net zero under disorderly transition and delayed transition itself. In the hothouse world, you have nationally determined contributions and current policies, as we said. So we have physical risk and transition risk. There is policy ambition, policy reaction, technology change, CDR or carbon dioxide removal, which is a big technological promise on which we are relying to reach decarbonization and net zero, and regional policy variations happening as a part of this. So color coding here indicates whether the characteristic makes the scenario more or less severe from a macro financial risk perspective. The bluish color is a lower risk here, and the yellowish colors are moderate risks, and the gray ones are the higher risks here. So There are various things. You can read the phase space carefully. For example, physical risk and policy ambition for net zero 2050. We want to aim 1.4 degrees C. Policy reaction has to be immediate and smooth. Technology change has to be fast. Carbon dioxide removal has a moderate risk. Medium to high use of CDR will be required to reach there. Of course, we don't have the scalable technologies yet, so these are sky in the pie technological promises. Regional policy variation here will be medium as well. And if you go to below 2 degrees C, which is worse than this one, then you go to moderate risk of policy reaction and moderate change of technology, medium to high use of carbon dioxide removal, and low variation of regional policy variations, and so on and so forth. So can we still go for disorderly transition and achieve divergent net zero, various countries doing various things, but still reach 1.4 degrees C? This would of course be low risk, but if you go to 1.6 degrees with delayed transition, that's moderate risk, and the policy reaction technology change will be higher risk. CDR and regional policy variations will be low to medium use, which means you are not trying as hard to reach the net zero goals and transitions to decarbonization and so on. So that's how you would read this in the hothouse world. Of course, you would exceed 2 degrees C, reach 2.6 degrees C, or more than 3 degrees C, and you will have lower risk in terms of this is, remember, these are from a macroeconomic financial risk perspective. So NDCs will still have lower risk and non-current policies. Slow change in terms of technology in both cases. Low to medium use of CDR, and very low use here, because you're basically allowing global warming to go on beyond the so-called reasonable limits of 2 degrees C and 1.5 degrees C, and the regional policy variations will be low as well. Obviously, these are various assumptions of storylines for the future. Is this how things will evolve? Of course, we can't guarantee it, because if you look at how the pandemic affected climate action and policies, and how the Russian invasion of Ukraine affected the climate action across the world, and energy use, increased coal use, and so on, it's very difficult to say what will happen in the future. The transition in terms of demographics, transition to renewables, transportation systems, green cement, green steel, etc., are all quite uncertain. Nonetheless, each NGFS scenario explores a different set of assumptions for how climate policy, emissions, and temperatures evolve. So here you have orderly, disorderly, and hothouse again. So CO2 emission scenarios going from 2020 to 2050 for delayed transition, divergent net zero, current policies, nationally determined contributions, net zero 2050, and below 2 degrees C have these various emission levels in terms of gigaton CO2 per year. So those are CO2 emissions by scenario, and where we would end up in terms of warming. This would give us, for example, is the current policies which are not stringent enough to stay within 2 degrees C. So you will get 3.2 degrees C, and this delayed transition will cruise along here with the current policies, but then will rapidly transition down to less than 2 degrees C, and the others will do a slow transition to less than 2 degrees C, with the most ambitious, the most beneficial one being here, with divergent net zero but reaching 1.4 degrees C, and same with net zero 2050. And carbon price development for these in terms of 2010 US dollars per ton of CO2 should be actually also CO2 equivalent, because if you just use CO2, then you have to worry also about methane, N2O, and other greenhouse gases in terms of their impact on warming. So temperature increase by 2100 and the carbon price per ton of CO2, you can see that we'll have to pay a lot, or we have to penalize carbon emissions a lot to reach 1.4 degrees C by 2050. It reaches $700 US dollars per ton, pegged to 10. But with various other options, you hold lower prices for a longer time and reach the same target here, 1.4 degrees C, and this is 1.6 degrees C, but here the price is low but the transition is later, and you will get higher warming here, 1.4, 1.6, and if you want 2.6 or 3.2, obviously you can allow carbon emissions to go on without much penalty, without carbon cost, carbon price, but you will of course end up with much higher global warming. We'll look at this in a bit more detail in the US context in the next podcast as well, but the climate to financial risk transmission channels include the physical risks, which are split into chronic and acute, and then there are transition risks. So these include policy, regulation, technology development, and consumer preferences, how behavior will change into the future in terms of reducing individual emissions and supporting policies for reducing overall emissions. And physical risks include chronic, so slow changes in temperature, precipitation, agricultural productivity, sea level rises, and so on, with acute physical risks coming from heat waves, floods, cyclones, wildfires, and such. The economic transmission channels then are micro, so affecting individual businesses and households. So here are the businesses and households with examples including property damage and business disruption from severe weather, or loss of income from weather disruption and health impacts, labor market frictions, and so on. In the macro economic context, aggregation impacts on the macro economy occur through capital depreciation and increased investment, shifts in prices from structural or structural changes or supply shocks, and other impacts on international trade, government revenues, fiscal space, output, interest rates, and exchange rates. Obviously these include, hegemonies between, let's say, China and the US or the rest of the world, geopolitical perturbations or disruptions like the Russian invasion of Ukraine. Everybody thinks China will invade Taiwan, and so on and so forth. All those go into here. So those are non-climate risks, of course, but still they will play into the transitions here. Financial risks include credit risks, so defaults by business and households, collateral depreciation, market risk, replacing of equities, fixed income, commodities, etc. Underwriting risk, increased insured losses, increased insurance gap in terms of climate risks versus what you insured for, let's say floods or sea level rise or cyclones and fire risks and so on. Operational risk, supply chain disruption and forced facility closure, like port closure, let's say, because of sea level rise. Liquidity risk, increased demand for liquidity, and refinancing risk. So these are financial system contagion here between various aspects like credit risk and liquidity risk, and you also have climate and economy feedback effects between climate risks and micro and macro transmission channels, and between financial risks and economic transmission channels you have economy and financial system feedback effects. So all these things are supposed to be modeled. So the NGFS provides models, data, and navigation tools in terms of guidance, and there are various tools used. So again, looking at transition risk, physical risk, and looking at data available in the EASA database and data available in the NGFS Climate Assessment Climate Impact Explorer. So here is the NGFS suite of model approach, which we already looked at in terms of transition pathways with integrated assessment models. If you don't know what integrated assessment models are, I have separate podcasts on those. Okay, they are not the most ideal tools. There is a lot of debate about whether they are even suitable for the job, but nonetheless they are extensively used by the IPCC and by various sectoral applications like these. Energy and emission variables going into macrofinancial risks. So there is a macroeconomic model, temperature alignment, various targets here affecting chronic climate impact. So transitioning from the transition risk to mapping on physical risks. So this is using Earth system models and climate impact models. I have podcasts on these as well. And acute climate impacts, so these are chronic and these are acute. So these are natural catastrophe models looking at how shocks like hurricanes or cyclones, wildfires affect the various impacts on socioeconomics and so on and so forth. And they also feed country productivity damages and assets damages into the macroeconomic models. The NGFS scenarios consist of a set of climate-related and macrofinancial variables available for each model, scenario, and geography. So NGFS scenarios here have transition pathway variables with macro regions and countries involved, physical risk variables, again 30 plus macro regions and 180 plus countries, and macro financial impacts. So these of course include emissions, energy use, electricity capacity, costs, energy trade, energy price, carbon price, policy cost, and so on. And under physical risks we have country level temperature, high GDP change rate, median GDP change rate, labor productivity impact, economic damages from floods, economic damages from typhoons, and so on. And translating to macro financial impacts, we looked at in terms of coal, gas, oil price, consumptions, GDPs, unemployment, housing prices, inflation rates, private investments, public investments, and so on. So essentially these are, you are making lots of assumptions into the future about those, taking the financial risk variables from IPCC models and translating them to GDP rate changes, labor productivity impacts, and so on, and then adding the transition pathway variables and reaching the macro financial impacts. Some results, I won't go into the details. I mostly wanted to give a sense of the scenarios from NGFS, translating climate risks into micro and macroeconomic risks for the future in terms of scenarios. So integrated assessment models and damage function. Damage function is something that translates temperatures or other climate variables into the future as projected by IPCC into various financial and other impacts on sectors like cement, steel, supply of critical minerals and metals for transition to renewables or EVs, and so on and so forth. There's a lot of debate about whether these damage functions are really reliable and trustworthy, or they are just knobs to turn and get different numbers for the future, and so on. But we'll leave that debate for another time. So here you are looking at temperature evolution, various scenarios, delayed transition, divergent net zero, current policies, NDCs net zero and below 2 degrees C target, chronic physical risk impact. So this is asset and productivity damage as a percentage of GDP due to high global mean temperature. So you can see these are all negative numbers, so obviously GDPs are going to take a hit in terms of percentages, with some of them being fairly severe. Coming down here, this is the black line, which is basically the current policies, which are not strong enough, and NDCs are slightly better, but to stay below 2 degrees C and so on, to save the loss to GDP, we have to do a lot of things like energy transition and so on, which we will look at in a minute, and increase the cost of carbon, for example. Transition risk impact, of course, carbon price increase, as we just looked at before, and these are fed into IAM's like NIGEM, which shows its own GDP impact, various countries like China, Europe, regions, China, Europe, Latin America, and the United States. The scales are different, so you have to be careful. This is the PP change from a baseline. So these are like a management terminologies, percentage performance change, I think. So you can see this is going up to 2.5 here, and -1. This is going from -0.6 to 1.2. So be careful. And Latin America has a higher range from -1 to 3.5. United States from -1 to 2. And acute physical risks. So these are GDP impacts as percentage change from baseline. as you go into the future, the impacts increase as a percentage of GDP out to 2050. Again, current policies being the worst. In other words, the co-benefits of climate action are such that GDP loss will be reduced. That's the key message. Okay, that's what the motivation is. In terms of the various inputs, also looking here at the scenarios from IEA for net zero by 2050, GCAM model, one of the integrated assessment models from University of Maryland and Joint Global Change Research Institute, message, remind. You can see how they do things here for 2030 and 2050 in terms of gas use in exajoules per year, share of wind and solar in electricity in terms of percentages, how they grow. So each model has a different estimate here. So this is 2021, 2029, and where we need to be by 2050, and here where we need to go down from the 2019 baseline to reach our global warming targets and net zero targets, decarbonization, and so on. You want the gas use to go down and the renewables to go up, right? So these are the share of wind and solar in electricity as a percentage. Large range here in terms of 25th and 75th percentile, but that's because different models produce different numbers. Final energy use in exajoules per year, again from 2019 baseline, it has to go down. By 2050 it has to be much further down. In terms of carbon dioxide removal with afforestation, so increasing forest cover, plus BECCS, which is bioenergy and carbon capture with sequestration, gigaton CO2 per year. So you have to reduce our emissions here from the maximum 16 down here into gigaton CO2 per year in the range of as little as 3 gigaton CO2 per year to about 8 gigaton CO2 per year. So that's the CDR. So that's what it means. The update of the NGFS scenarios, they have been brought up to date with new economic and climate data, policy commitments, and model versions. So this is the third phase we are looking at. Improved modeling of physical risks, so estimates of GDP losses from chronic risks now more fully account for model uncertainty. And secondly, improved modeling of physical risks also looks at acute physical risks being included for the first time via the integration of stochastic shocks going into the future. Okay, so modeling of acute physical risk, historical damages from extreme events, so that's the emergency events database, to feeding into frequency and magnitude increase, so that's with the Climate Impact Explorer, and macroeconomic and financial impact using the NIGEM integrated assessment model. So increased sectoral breakdown looks at cement, transportation, steel, and so on. So transition risks are represented with increased granularity in certain sectors. And looking finally at results, GDP deviation due to transition, chronic and acute risks from one of the models, the Remind model. So go from 2030 to 2050 and 2100 in the net zero scenario. In the delayed transition scenario, again the same timelines and current policies here. Okay, so chronic physical risks, transition risks, and acute physical risks, how they add up in terms of loss of GDP. By 2030 here they add up to about 2.5 to 3% of the deviation from the baseline, and for 2050 it'll be more than 4% loss. By 2100 you would recover with all the action back to being just over 3%. This is global. So in the next podcast we will see how these are now going to be done for the US based on the US Federal Reserve's guidelines that combines the NGFS scenarios with the National Climate Assessment of the US, to do it at very local scales like states and regions, Northeast US and so on and so forth, with specific acute and chronic risks like cyclones and temperature increases, agricultural losses, and so on. In the delayed transition, you get So this is from the net zero. So you will have more action, so you will lose more GDP here. Delayed action doesn't cost as much, but as you can see, by 2050 it'll cost a lot more, almost 6% deviation from the baseline, and by 2100 yeah, it is at minus 4%, whereas net zero will bring you back to less than it's not just over 2%. So there is a price to pay if you do delayed transition. With the current policies, it's a disaster. So 2030 looks nice with respect to net zero targets, but the co-benefits are lost. So by 2050, you will be almost 8% below baseline as a global GDP. By 2100, you will be almost 20% loss in terms of acute and chronic physical risks. Okay, so you can see that in 2100 transition risk is gone because we are already where transition is done with either net zero or delayed or current policies. Okay, so that's how you would think about it. This is GDP deviation relative to the baseline, again for different regions: United States, developing Europe, Latin America, Asia, and Europe. I just wanted to show it to see that there are divergent projections for different regions, and even for global GDP deviation relative to the baseline in the net zero 2050 scenario, there are divergent loss projections from different models. So different models produce different global numbers. Of course, that means also they produce different regional numbers. So these have to be taken into account. And looking at sectoral GHG emissions for net zero 2050 scenario as an example, in terms of tons of CO2 equivalent per year, you would want them to drop, of course, to stay on the net zero 2050 goal. So you can see that these are energy supply, buildings, industry, FOLU, FOLU is the agriculture, forestry, and other land use, and transportation has to get electrified and go to zero emission very quickly by 2040 or so. And modeling climate policy and climate change has this feedback loop where climate impacts can be fed back into the baseline once you start with climate impacts from IPCC. So you have to do socioeconomic development. So integrated assessment models start with a hypothetical baseline based on the shared socioeconomic pathways, which you will see in the next podcast, but also I have separate podcasts on these that you can look at. Energy and land use, assess changes in energy, land use, and policies needed to meet carbon budget in terms of global warming targets. So emissions have to be determined from those. Then IAMs estimate temperature outcome given a range of climate sensitivities of the models. So as CO2 increases, how much warming does a model create? That's climate sensitivity. That gives you the climate change you want to feed into the climate models, which can be aligned to assess physical impacts, so that you can then use the economic models to do financial risk assessments. Obviously, I'm going relatively fast. It's a brief introduction, but here is the average annual energy investment needed to 2050 in terms of trillions of US dollars. You obviously want to cut out the emissions in fossil fuel electricity. So current policies have a number higher, but net zero will need that to go down quite rapidly. And similarly, fossil extraction investment currently is high, has to drop quickly by for net zero 2050. And this is nuclear remains the same in this. So these are NGFS numbers given to the models. Renewable electricity current policies are at about 1.25 trillion US dollars or so, but they have to jump to almost 1.8 trillion US dollars or so for the net zero 2050. Primary energy mix per scenario. So current policies and net zero 2050 require, of course, that for net zero we need to have renewables and biomass grow to almost 70%, whereas the current policies rely a lot on oil and gas and a little bit on nuclear and a lot on coal. Even in 2050, there is significant coal according to current policies, and renewable and biomass grow, but obviously not as much as they should for achieving the net zero 2050 goals. Okay, so these are the range of things. There is a physical risk, GDP losses by country. These are the current policies. So you can see that the global south has massive losses here, almost 40%, which is real disaster in terms of GDP loss. The physical risk GDP losses, net zero 2050 and current policies to 2100. Current policies, if we don't change, will crash to over 10% with a large uncertainty range by 2100 in terms of global GDP. But if we stick to net zero, there is a huge benefit in terms of reduced GDP losses. Similar things from acute physical risk. So net zero and delayed transitions are here, but current policies are down here with GDP loss that may become quite unacceptable. Implications of alternative monetary policy rules for selected economies. These are what are fed into the models. So for the US, for Euro area, for Japan, in terms of GDP percent deviation from baseline, inflation, and interest rates. So when you do these for the future, you assume all sorts of things, and you have to just remember that the uncertainties tend to be closely tied to the assumptions you make into the scenarios or the storylines. Finally, how are the physical risks modeled? Direct and indirect impacts of extreme events, scenarios differentiated by duration and magnitude. So acute and chronic risks, right? Hurricanes, cyclones, wildfires are fast acting and magnitude can be high, and you have temperature change, sea level rise, and so on, which are slow and lower in magnitude. So it's the idea of a frog in a slow warming water versus putting it into a boiling water, and so on. So there are the climate events with physical direct impacts. So first order damages, example, destruction of critical infrastructure, production, and housing. And there will be indirect impacts in terms of the destruction of critical infrastructure affecting labor productivity, health, water quality, air quality, and so on, for example. Transmission channels and cascading effects. Physical indirect effects come in here with second order damages with impacts on the economy, impacts on the public finance, and impacts on the financial sector as a whole. NGFS has next objectives, phase 4. So we looked at phase 3. They want to improve the design of the NGFS scenarios and promote their wide use by a broad range of stakeholders with technical and strategic objectives of improving scenarios, updating scenarios. So sectoral granularity, geographical coverage have to improve. Usability and complexity of the scenarios have to be managed in terms of trade-offs. Short-term scenarios have to be introduced. Physical risks have to be represented better. And strategically speaking, make NGFS scenarios a common standard for all financial institutes across the world, like central banks and supervisors. Improve usability, so limit the complexity of the scenarios, make them off the shelf. Improve transparency and provide users with methodological guidance. Broaden the user base and increase the range of usage of NGFS scenarios. Okay, so this is the next podcast. This is a bit long, but it's worth doing this. It's almost 40 minutes, which usually is not how long I make the podcasts, but nonetheless, here we are. I hope it's useful. If you want more details, you obviously need to read up on your own. And also remember that I'm a climate scientist trying to offer this as an introduction to the students. So if you're an economist or a financial person, you need to follow up on the details of what is fed into the macroeconomic models and the integrated assessment models. Okay? Thank you.